Let me share the screen. All right, make China great again. So, of course, as usual, our webinar has always been for the purpose of education and information purposes, right? Please do not use it to take it as financial advice and do your own research. And definitely, whatever I'm sharing here today would be my own personal view, and that does not represent what my employer and my other colleagues' point of view. Okay, and if you're joining us first time for our Premium Cup webinar, of course, this is something that we will continue be doing every fortnightly on Premium Cup webinar, where I would either be sharing a deep dive into a stock that I'm researching on or some of the key markets update following the stock market and how it will impact our portfolio and how practically I'm maybe adjusting to all these updates. Of course, I'm also a wealth advisor for iFAST Global Market in Malaysia, and iFAST Global Market is basically an advisory platform and trading platform for all of you guys to either do your own trade or talk to me personally as advisor to build up a key portfolio for you guys. And the key reason on why I started this journey, this move to iFAST is mainly I realized that my biggest strength and my biggest passion in investing is really to help people carve out what I call an everlasting portfolio. And this has been something that has been very useful for me through creating a portfolio that truly can stand the last test of time. And I have been seeing real results on it, and which is why I'm using the same philosophy of looking at long-term trends in the market, collecting very, very high quality companies, either through ETF or through stocks directly, and keeping a contrarian view in the market always, and building up a portfolio where it's scalable, right? So it's something that you can continue to use the same strategy over and over again throughout the test of time. And as member, I have been trying to utilize that same strategy in building my ETF portfolio, which I share with you, update every single month. And this is at the beginning. At the end of it, I'm gonna share with you the update on what is happening to my stock ETF portfolio. And I really see myself as a craftsman, and the thing that I craft is really portfolio. And I enjoy even seeing other people portfolio, how they build up their portfolio. And I think that it really can tell me a lot on about the investor, about how you think about investing in general, and sometimes even life in general, just by looking at your portfolio and how you manage it. And I'm always fascinated by so many different approach to that. And I hope to share more about my own approach with you guys as well. And hopefully, you agree with me, and that rubs off a little bit to you guys as well. Okay, but the main topic for today is going to be about China. China. And this we're gonna dive deeper into what really happens and why has the stock market been rallying so aggressively over the past weeks, and what are some of the goods and one of the bads, and what are some of the possibility that would lead to going from here, and how best we should be positioning our portfolio on that, and also what I am doing with regard of all this new development. Because as you guys know, my own portfolio predominantly is exposure to the US market and also the Greater China market, right? So I tend to have very, very little stocks exposure to the local market, say Singapore market or Malaysia market. And the Greater China market and the US market has predominantly been where I'm more focused on. And this is an update on what is happening after this development. So The Chinese market, I'm sure you guys have already know, has seen very, very spectacular rebound just this week alone. The Hang Seng, this is taken just, I updated it just yesterday night after the big crash. And uh, the Hang Seng index is still up 22% despite the 9% drop yesterday. And the China A50 index is up 27%. Also, that's after the 11% drop from yesterday. So it was previously up, close to 40%. Um, the Some of the more interesting stocks as well that I have always been talking about, or some of the bigger stocks around in the stock market. Say Tencent is already also up about 19%. Guizhou Maotai still continue to be one of my key position, is up about 37%. And even the biggest bank, ICBC, banks has been quite treading water for the past decade, but even banks, we are seeing a recovery. ICBC up 12% just this week alone. So why? What's exactly happening right here? So we have to rewind a little bit back, maybe even before 2020, right? So for the past decade, the US and China tension has been brewing, right? And it has never really subsided. And that leads to a lot of US capital moving out of China, just becoming more and more pessimistic about China. And we've seen the valuation of Chinese stocks keep falling year after year, even among very, very high quality growing company. And then, if that's not bad enough, by 2020, uh, the government realized that maybe the property market is a little bit overheated, and they wanted to cramp down on it. And they started having a requirement, say, called the three red line. And that is in a way to try to control the Chinese property market developers from becoming too over leveraged and make sure that they have ample cash and cash flow to sustain their business. But I guess that one is a little bit too late, and that led to many fears in the market and many projects being abandoned. And of course, the most notable one is Hengda, which is Evergrande, and that leads to some of its bond being defaulted. That leads to more fear in the market, both in the property sector and also in the stock market and in the general economy, because the property sector is still such a big a part of the Chinese economy, right? From there, we lead to even bank fears, because most of the banks, of course, the predominant of their asset is still going to be mortgages and also loans to property development company. And with the three red line requirement set by the government, the things like the liability to asset of the developer company cannot be more than 70%. Their net gearing shouldn't be more than 100%, means their equity, their debt cannot be more than their equity. And one interesting one is also their cash to their short-term debt, their liquidity ratio should be at least 1. So, whatever amount that you take from short-term debt, you should have a cash reserve to cover that. So that is pretty hard to match, given that they have already been growing so excessively over the past few decades. And property has been a very, very big area of storage for wealth for the Chinese investors. So that is very, very fascinating to me that, they didn't see it, but that leads to quite a lot of fear in the market. But the economy of China basically works in such a way. The government try to cool the economy, and then the policy is a little bit too drastic. It makes everybody panic. And then the government realized that, it's maybe too panicky right now. Let's pump the economy and repeat the cycle. So that's basically what they have done. In the past week, they have put in a lot of measures and stimulation measures to try and to revive the market a little bit. So some of the things they do predominantly is still targeting the banks and relaxing the requirements for the banks to make them have more liquidity to lend, have a much lower interest rate so that they can continue to lend at a more attractive rate. So things like their 7-day and 14-day repo. This is loans that the central government give to the banks will be lowered in interest rate. Even the midterm one, the 1-year loan to the banks would be lowered, by 0.3%. They also reduce the reserve requirement for the banks. So previously was 10% that they need to put in reserve for whatever amount that they loan out. So that was reduced by 0.5%. And there are talks that they will continue to lower that another 25 basis point to a 50 basis point later this year. So every 0.5% that they lower the reserve requirement, they give the banking system about 1 trillion of renminbi more of liquidity for them to start lending again. So in hope that they will stimulate the economy and start the engine again. They also have a program where the central government is going to lend to state government and province government to allow them to buy back some of the abandoned projects. And previously, they was able to lend about 60%, but that has been increased to 100% funding. So they are encouraging state governments to go out and repossess and reacquire some of the more damaging developments and turn them into affordable housing. So you can expect, this will have a major impact on solving some of the issue in the market and quenching some of the fears that investors have, especially in the property market, right? If you are a property investor in China, you could be seeing, in the past few years that your entire equity on your property been wiped out. So your loan could be more than the entire asset price of your property. That is a scary thought. It means that even if you sell off your property, you will still have outstanding loan that you have to continue to pay back. And hopefully this will help out in some of the situation. And not just the property market, the government is also pumping money directly into the stock market. So they have things like the swap program funds that they allow some of the companies to, especially the financial companies, to start buying back their own shares. They have also will be adding more stability funds throughout the continuous next few quarters, or maybe even for the next few years. So these are things that they have in place, and it has injected a vote of confidence to the investors, and this is why we are seeing such a huge jump as well. So the government is basically, with all this action, telling investors that, it's time to buy property now, it's time to buy stocks now, it's time to buy China again. But everything that the Chinese government do, they like to do it in style. And this has been a long-awaited release, because for the past 4-5 years, the stock market has really been very, very negative. The investors has nowhere to really invest their money. And once you give them a little bit of bright light, I think everybody finally see an avenue where they can finally start investing again. And maybe also investors might be thinking, because the Chinese government decision is so uh, important in the Chinese market. And since they are optimistic now, we should better act quick before they change their mind. This is just my assumption that if I'm an investor in China, that will be something that I'm feeling as well. And plus, we are also seeing a short squeeze among many of the Chinese stocks over the past few weeks as well, because for a long time, many investors has been shorting the Chinese market just because of the negative sentiment, especially foreign investors. And that has really led to a short squeeze in the market. And many of them, seeing such a huge recovery, has to cover their shorts. That led to them buying back their position, creating an even stronger upward movement. Plus, the Chinese market is actually a place where gross saving rates is very high. The gross saving rate in China for the past 30 years has always been hovering around 40 to 50%. That's an extremely high savings rate for a country. And the basically people has a lot of ample savings lying around, both companies and also for the citizens. And it's a good way for them to start investing again. Whereas, compared to a developed market like the US, the gross saving rates for US is actually just around 15 to 20% most of the time. So you can see that there is a lot of liquidity in the market, just they need a place to go to. So even after all this huge rally, is the Chinese market really expensive right now? Right? Is it something that we should totally avoid? And in fact, when we look at their key ratio against all the index, the Hang Seng index and the Shanghai index, they are actually not expensive at all. The Hang Seng index, even after the recovery, is still trading around 13 times, right? For the past few years, you can get it below 10 sometimes. But it means that most of the top companies within Hang Seng are trading at around 13 times, which is lower than their 10-year average, or about 15. The Shanghai index is also at a similar situation, that Shanghai's index stocks are trading at around 9.9, which is about 10. And that is also just slightly, ever so slightly below their average of 11 times. So I would say that in terms of valuation, the Chinese stock market is actually still not that expensive. But of course, compared to their average, they're just a little bit lower than average. But if you compare to other markets, say the US or Europe, they are still one of the cheaper markets around. But the question is, does valuation really matters that much in China? Sometimes I'm not so sure. Mean, sometimes I'm not so sure. I'll share with you a reason why. But I'm still a investor in China, and I still continue to believe in some of the companies that I invest in, some of the ETF that I invest in China. And basically, what I'm looking at in China is sectors, either if you're investing in ETF, sectors that the government is supporting, right? Or businesses that are very strong with high moat. I like businesses that employs a lot of people. So they are a big employer in the country. And that means that the government would try not to disrupt this kind of business too actively, given that they are big employers or for the Chinese citizens, and they want employment to be stable. And also, if some of the companies have key IP or key supply chain moat that the Chinese government deem as national security that they want to protect, maybe this will be sector that still continue to have the blessing of the government. So, for example, things that I'm looking at or actively investing in would still be the technology sector for one. Um, you guys would know that I have been a long-term investor of companies like Alibaba, Tencent, Meituan for a long time. Even the EV sectors, I think more or less Chinese EV companies is has proven that they are going to be the dominant player worldwide, not just in China. Although they might have a supply glut at the moment, and that might lead to some supply oversupply issue. But in the long term, I would think that they will still continue to be the leader for many years to come. And even though I'm not invested in, but the banks would be something that is a key to the national security of of the nation, and this will be a sector that I feel will continue to be protected. So the Chinese banks, even though they haven't been seeing very big stock increase in prices in market cap, but they are some of the biggest dividend payer among Chinese stocks right now. You can get dividends of around 8, sometimes to 10% for some banks. So if you're a dividend investor, that could be something to look at. And also another one company in particular that I'm still studying, of course, is CATL, right? So company that has a unique proposition and unique product that the government might still deem it as important, uh, like CATL, which produce all the battery packs for a lot of the EV companies. I think that will be an industry that should continue to thrive for many years to come. But this come the big but, that at the end of the day, the sorry, at the end of the day, the most important thing in the Chinese government, in the Chinese stock market, is the Chinese government policy. The policy, you can see that it makes or break the stock market. And there are many instances over the past decade that the government can completely shut down a company, regardless how big they are. They can change the entire policy and destroy business model of a company. And they can temporarily withhold licenses for companies until they adhere to what they like and what their policy is going to be. So it's hard for us to predict, especially for foreign investors, to predict what the government policy would be next, what they deem to be important for the country next. To us, when we look at it, it can even feels a little bit irrational at times. And sometimes the movement and the policy can be very drastic. Case in point, for example, the property sector, where they want to calm down the sector, it's straight away implementing the three red line and very drastically trying to pull the handbrake on the on the sector. Rather, when we see it in other countries, say even in Singapore or even in the US, they'll do it in a gradual stage by increasing the interest rate, increasing the stamp duty, just to slowly cool down the market instead of such a drastic measure like the Chinese government. So I think that will continue to be their style, and that could be erratic at times, and so there will always be a certain amount of risk that we cannot predict and cannot foretell when is it going to happen for the Chinese stock market. So how I view it is it's very hard to have a very large allocation in the Chinese stock market. Say for example, for myself, I would say predominantly my wealth and my investment is mostly in the stock market, right? So above 60-70% would be in the stock market. And if you ask me if I'm going to have a large allocation to the Chinese stock market, say more than half of my entire portfolio just in the Chinese stock market, I think it's very hard for me to swallow that risk, especially coming from a risk that is unpredictable and I cannot foretell. Instead of, I rather focus on markets where it's more market driven, And I know that as long as this company is doing great, there will be a chance for me to see long-term growth within the company. So what does that at all means? It means that when we're looking at the Chinese stock market, it's very, very important for us to have an even higher requirement. So in investing, I feel that we should always have high requirements on the stock that we buy. We shouldn't just be buying every single stock that we see, every single stock that feels that they are going to go up. We should actually be having a very, very high requirement. I see them as, if you're thinking of this company are people and these are the people that potentially I'm going to let my daughter date. So I'm going to have a very high standard of it. But if it's coming from the Chinese stock market, I would want to have an even higher requirement just to make sure that I'm buying the cream of the cream, and investing in those and to reduce the downward risk that I could potentially face. So things like, is it a great business? Does it have a very, very strong moat? And is it growing, right? Not just growing in terms of revenue, not just growing in terms of profit, in terms of their free cash flow as well, so that the company itself has enough cash to uh, grow by themselves organically without the need to either inject new funds into the company or relying on bank debt. And of course, a very important point is to buy it at a good valuation. I would say that compared to, say, the markets like the US, where we can be a little bit more flexible with valuation, I would say that I would try to have a much more stringent requirement on valuation for Chinese stocks. But also, one very important question I think that you must be thinking, and some of you might be thinking, and this is a question that I have gotten in the past week, is should we be chasing the rally? Is this gonna be a short-term rally? Is it still too late to join the rally? Um, Very sadly, I might be giving you an answer that you might not want to hear, which is that if you are asking this question, I think you're doing it wrong. Uh, you might hate me for this, but if you're asking this question, it means that we are falling into the trap of just fear of missing out. We're seeing this rally and we feel that we need to chase it. We're seeing that other people are making money and we feel that we must be part of it as well. And that is never a good starting point on investing. That's because once you start to have this kind of thought, once you start to feel that whenever there's something interesting in the market, you have to be a part of it. It's a never-ending cycle. Over the past 15 years, 16 years that I've been investing, these are just some of the fabs and some of the uh, hot trends that has been coming and going in the market. Do you guys still remember BRICS? BRICS was such a hot thing and everybody wanted to be invested in BRICS. Even way back in the 80s, you have junk bonds. In the 90s, you have Japan. You have an oil cycle. And then now oil cycle is coming back, of course, but for a long time, oil cycle has declined. And then people is talking about renewables. For a period of time, people want to be investing in tech, but not just tech companies with which is asset light. And then now they realize that, it needs to be asset heavy, so you can have a little bit more moat. There are periods where people want just to invest in small cap, and then suddenly people want to invest in large cap. There are periods where people just want to invest in gold, right? And for the past few years, in trends like EV, in Bitcoin, in China, in AI, what's next? It's a never-ending cycle. It's just last week, when I joined in another fund manager talk, they're starting to push on healthcare. It's just a story that uh, they wanted to push and explaining how great of an opportunity is the healthcare sector right now. But nothing has really changed. The healthcare sector has always been the healthcare sector. It has always been doing well. Um, and it's it's all just marketing. At the end of the day, all these trends are mainly coming from marketing, and we should not be a part of it, because investing should be something that we plan to do for the long term. It means that something that we wanted to do to in a sustainable manner. If all we're doing all the time is just chasing fab, it will never be sustainable, because we are just doing exactly what everyone else is doing. How can we expect, to have a different type of outsized return and better than average return if we're just doing everything the same as what everyone is doing, right? And to me, I feel that investing is more of a skill and a system. And as long as you realize what is your system and what is the kind of system that you want to create, then you might have a winning formula for your investing journey. For example, what I basically do is I would, during the normal times, I would just be building up my watch list. So I would have a list of stocks that I might find interesting, either from, it can be just people telling me about the stock. It can be coming from a screen. It can be coming from a news article. It doesn't matter, right? So even now, you can read about some great AI company that you feel is interesting. That would actually goes into your watch list stock first, rather than a stock that you must buy straight away. So within all this, once you build up this list of stock that you could be potentially investing in, you will screen them, you will qualify them, you will research about them to find companies that pass your test. Companies like what I talked about just now, great companies, growing companies, and with strong balance sheet, basically. Or ETF. It could be ETF, it could be a sector. Once you understand the sector and look at the ETF that you like, understand some of the top 10s holding of that ETF, it could continue to be sitting within your watch list. And then you can decide on or how you want to build your portfolio. Basically, how you plan out the asset allocation of your entire portfolio. So if it's something that you want to build up over the long term, and say, for example, that you are uh, still prefer to have a big part investing in your local markets, you can say that, okay, 50% I want to invest in my local markets. I'll have 30% invest in the US market and 20% maybe in the China market. So now you know that this will be your asset allocation. Then you choose from your watch list either ETF or stocks or funds that you want to buy, and put them into this asset allocated version of your portfolio. And within that, then you can simulate a portfolio that you want to build. And now you just wait for the right time. Sometimes if you want to wait for the right valuation before you start buying a stock, then this would be it. You from your watch list that you have green light, then you're just waiting on what is the price point that you feel is a good time for you to start investing in. And then if it's ETF, if you want to do dollar cost averaging, it could be something that just you buy it at a dollar cost averaging to build up your portfolio over time. That's fine as well, right? As long as you have a system and a systematic way on building up this portfolio, on maintaining this portfolio, I think that is already a much bigger leap forward than what everyone is doing, and give you a much higher chance that you can have a successful investing career in the long term, right? So I really hope that is something that you'll consider to start to incorporate into your own investing process. And some of the key criteria, I would say, if you're quantifying, if you're qualifying an ETF or a stock, these are some of the things that I always look at. I want an industry or a company that is growing in a big addressable market. So I want to see that number one is growing and it has a big addressable market. Number two, I want it to have low debt. However great of a business, if it has very high debt or high gearing, I tend not to invest in it because you never know when the market can turn during a crisis period, and the company needs to survive that crisis. And no matter how great the company might be, if it has high debt and it reach a down cycle, it still has the potential of going out of business. And that's something that I want to avoid. Number three is having a good management. And this is hard to come by. Sometimes we have to look at great founders as well. I would say the best possible thing that you can look for is a great founder who is also a great manager. Very, very few in between. But you don't really need many stocks in your portfolio as well. So if you can find, just a handful of them plus a portfolio ETF, you can build a pretty high quality portfolio for yourself, something that you can sleep quite soundly at night. And do it all within your circle of competence, right? So you don't have to chase after every new industry that is coming up. You can take time to learn about the industry. You can take time to widen your knowledge on different industry and different companies. And I would say that start from industry or companies that is within your own work or consumer companies, which is what I started in because um, when I first started working, I don't really have any expertise in the industry that I work in. So I really just start by focusing on learning about consumer companies, companies that I am customers of, and give me a better understanding of all these companies, how they work, why as a customers that I would want to buy them, and that give me insight on how well and how sustainable that business could be. Right. Another thing that we have always been talking about all the time for the past few webinars is the idea of a moat rating. Right? Every business that you look at, try to think of whether this business truly has an advantage compared to the competitors. Is there something unique about this company, or is it just big and a lot of money has been plumbed into it to grow it into such a scale? Or does it truly have something unique that is protecting its business? So moat can be anything from economy of scale, a great branding like Apple or many of the luxury product, your Hermes, your LVMH. These will be companies with strong branding. Economy of scale is company which has such a large scale that it's very hard for competitors compared with them. So, foundries like TSMC would be such a company which have the economy of scale that not many people can compete with. Or the network effect, companies like Meta or even Google that can make use of the huge user base that they have because because my friends is on it, and then it makes me want to be on it, and it creates this network effect that to add more and more users and this compounding effect that they have. Or companies with particular IP, maybe your company like Qualcomm, that they have very strong IP around their technology. Even when Apple want to cut them off, Apple realize that they're still not there yet. They cannot really cut Qualcomm off yet, and that says something about the intellectual property of Qualcomm. Or just companies with high startup costs, or they control a certain some part of resources that no one else can get, and even just switching costs, especially when it comes to a lot of the cloud players, a lot of SaaS players like Salesforce, your Datadog, these companies has very high switching clause. Once the customer has started using their services, and all their data is on that services, is very, very hard for them to switch. They need a very, very um, drastic issue to happen to them for them to even consider switching out of all these providers. All right. So that has been just a quick chat with you guys on the Chinese stock market. And I really hope that you find it useful for you guys. So it really goes to shows that it is not the time. If you are really thinking of, I don't have any Chinese stock exposure right now, should I be chasing it? It's a little bit too late for you if you have no knowledge on the Chinese market to start with. And in fact, I will encourage you to start really looking into your process of how you want to create this portfolio, and to be able to position your portfolio for the next incredible upturn. And most of our investing return actually comes from very, very short period, right? Even though, people can say that, say, if you invested in the S&P 500 over the past 10 years, the investment will grow about 10%, right? In theory, yes, that's correct. But the 10% mostly comes from just a few days of very, very high jump in the stock rally. So for example, if you just miss out on the 10 best days of the S&P 500, like just the 10 best days over the past 20, 30 years, your stock return can drop by close to 3%, right? So from 10%, it can drop to just 7% if you just miss that 10 days. But if you miss out 30 days, your stock return could more than half, could go to like just 3 or 4% total return, annual return over the past 20 years. So it really goes to show that it's not really about timing the market, because we can never, never, ever time the market. It's impossible to time the market. How do we know when the Chinese government is going to have a stimulus package? And how do we know beforehand that how the market is going to react? So it's a futile attempt trying to time the market, but the real wealth is created in our time inside the market. So as long as we have a good process and we build up a portfolio that we can be comfortable in to stay invested in, then of high quality stocks, then we will have a chance to enjoy this uptick of the stock market over time. So I hope you find that useful. And I would encourage, for this is our spin-off segment. I will encourage you guys to also check out our latest episode on YouTube, on our podcast, Kopi in a Year. It's just me chatting with a few friends on some of the stock ideas that we are talking about, some of the stocks that I have been researching on. And the key thing is not really to share with you the ideas that we're researching on, but rather a glimpse for you guys to look into our thought process. How do we actually view some of the stocks that we are looking at? What are things that we are thinking about when we look at a stock? And hopefully that will give you an idea if you're starting out, or if you want to do this on your own, want to research company on your own, give you a template on how to think about it as well. Okay, and that's basically has been my life's work, and I stick to very, very simple philosophy in my investing, which is, again, just focus on strong long-term trends that I feel that would continue to grow, and then not just things that I feel that will continue to grow, but rather what are some of the industry there will never be there will never be changing much, right? In an industry that doesn't change much, it's actually a good thing because those will be the industry that will test the test of time, right? And always focus on quality. There's so many stocks in the market. In every stock market, there are more than 1,000 stocks to choose from. If you are a global investor, you have 30, 40, 50,000 stocks to look at. And it it's really I really feel that there's no point in wasting our time in subpar quality companies when we can just go for the best of the best. And and the best of the best have the highest chance of growing for the long term and has the highest chance of not going to zero for us as well. And also, uh, a key idea that we talk about today is just keeping calm and being a contrarian. We don't have to follow the market. The market can do what they want. If we have our own path and if we have our own system, we can continue uh, that path and not be distracted by what the market is trying to do. And with that, to build a core everlasting portfolio that can stay with us for the long term. And that few simple guiding principle for me has been very, very successful for me. And I have truly seen the results on just practicing some of the things. And that's when I know that over time, over the past few past decade, I have been constantly making mistake. Right? Almost every year when I look back, I know there are times that I make mistake. And despite making that mistake, just still adhering to the grand idea of the simple strategy, I am still able to see my portfolio grow over time. And that is the system that I hope to be able to uh, duplicate and help the others who needed my help to look into their portfolio and revamping and improving some of the process and system for them, right? So uh, a simple way that I'm doing that is really now crafting out my ETF plus portfolio for you guys. And in the past three to 4 months, this has been the stock I have added, mainly a little bit of exposure to the Hong Kong market and some in the US market as well. So this has been how it is performing over time for the past 3 to 4 months. Okay, so I hope you enjoyed this little talk. And if something that I'm doing out for some of my clients is just doing a full financial health check for them. By doing that, I want to give my undivided attention when I look at a case. So I can't do it in a rush, and I want to make sure that I do a good job. And so if you want to join the wait list and for for the future, that I will reach out to you for a full financial health check to look at some of the things that you have worry about, some of the things that you are thinking about, uh, and also how you can maybe improve the system of your portfolio, or if you need help building up a new portfolio, do uh, tr just fill up the checklist form, the waitlist form, and I will try to reach out to you when I have the opportunity. Okay, I'll leave you guys with this simple quote from Buffett, one of the best quote that I like from him, which is the stock market is a device to transfer money from the impatient to the patient. And I couldn't agree more. Um, has been my own personal experience about the stock market, and I continue to see it every day. That in the best investors are typically the one that is not in a rush. That is the one who has the patience to wait it out, to wait for the true magic of compounding to start happening. For my own case, I would have to confess that in the first 15 years, 12 to 13 years of my investing, I didn't really see a huge change in my wealth, and I didn't really experience that compounding effect. Only after close to 15 years of investing, I truly start to see how compounding works and how one can become two, two can become four, four can become eight, and eight can be 16. How that effect really plays out over time if we continue to stay invested and not cash out too early and continue to let that portfolio snowballs. So I hope you guys have a great session, and I hope this session has been useful for you guys. If you have any question, feel free to pop out the chat box. I can still have a chat with you. If not, you can always still reach out to me via our Facebook group or from our WhatsApp. Thank you so much. I hope you have a great session, and till we meet again, invest safely, guys.